by the end of the year, let's say stock market's up 5%. Let's say it ends up down 5% or down 10%. That's a key signal for gold to go higher and Bitcoin to go lower. So to me, this is a sign that the massive speculation to this digital asset that helped get the president elected because he tilted over and finally turned in favor. Just pointed out things he wrote about 5 years ago. Now is at a level where I look at it's kind of, it reminds me of the nomenclature. You should be selling when they're yelling. And there's so much yelling in this space. Bitcoin looked great at 10,000, but at 100,000, it's just highly risky and speculative. And this is what it's showing. Gold seems to be picking up on that.
The analyst believes that gold could outperform Bitcoin as global investors shift towards safer assets amid rising risk-off sentiment. Despite Bitcoin reaching the highly anticipated $100,000 level, it is now lagging behind gold in performance. According to McGlone, this trend reflects broader market caution and the growing appeal of traditional safe havens. Senior commodity strategist at Bloomberg Intelligence, MikeMcGlone, highlights that since Bitcoin hit $100,000 in December, gold has outperformed it by rising 30%. He compares current crypto sentiment to the NASDAQ bubble in 2000. In a deflationary environment, he views gold as a safer investment option than speculative assets like Bitcoin. Since Bitcoin's inception in 2009, gold has outperformed it in only 3 calendar years, 2014, 2018, and 2022. While each of those years saw triple-digit relative outperformance, those gains came from steep Bitcoin sell-offs, not explosive gold rallies. As far as the market is concerned, McGlone highlights that gold remains undervalued relative to the S&P 500, despite its strong performance in 2025. He anticipates a reversion toward a historical 1-to-1 ratio as part of a broader deflationary trend. According to Jordan of the Daily Gold, this ratio has consistently signaled major shifts in investment flows between equities and precious metals over the market's century-long history, making it one of the most reliable long-term indicators available to investors. On the topic of deflation, McGlone cites crude oil's drop from $130 in 2022 to around $65 levels last seen in 2006. However, McGlone warns that the overvalued U.S. stock market must continue to rise to avoid a deflationary spiral, drawing parallels to Japan in the 1990s and the U.S. in the 1930s. He suggests Trump's team may be trying to prop up asset prices, but the timing could work against them. Before we dive into MikeMcGlone's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market.
Well, then the thesis is gold is high this year, is 3,500. It's very disconcerting. That put it up about 33% in the year. And in history of the last 100 years, there's only been a handful of years that have been up that much. Some of them, one was key, one when we devalued versus gold in 1933, 34, and the rest were inflation in the 70s. Now, this is not inflation right now. It's the opposite. The key thing I want to point out from there is we're in a bear market for most commodities, mostly crude oil, grains, the elastic ones, but we're in a bull market for gold. Gold's an enduring bull market. It goes up over time. Part of the reason is it doesn't have that elasticity of supply, even though it's an ancient relic and store of value. But what I put in the green there is what are things that could make commodities spike? Well, if you kind of some kind of crude oil supply shock, which we just kind of checked off is not happening at the moment in the Middle East. We could have a drought that'll spike up grains, which so far is checking off. We're not having that. Now it's July and August starting. Those are the key times. But the bottom line is, and everything is, you need the stretched U.S. stock market to keep going up to avoid the normal deflationary cycle that happens. I'll give you two examples in history. 1930s in U.S., the 1990s in Japan, when you get to 2 times GDP. So we have to stay there. And I think our Trump administration knows that. How do you keep those levels? And they're trying to do plenty of legislation to do that. But I think they have the unfortunate bad timing, like President Hoover did when he came in when the stock market was already too expensive and it just found a reason to go down. Basically, gold at the end of last year was relatively expensive versus everything, most notably other commodities, silver and things, but it's very cheap versus one key thing, the S&P 500, U.S. stock market. So it's starting to recover. S&P 500 is about 5%, up about 5% this year. Gold's up 25%. To me, that's part of that reversion of the per ounces of gold going back to about a 1-to-1 historical ratio with the S&P 500. Right now, S&P 500 is just above 6,000, and gold's running 3,300. So it's a matter of time. I think it gets back there, and just do we have that catalyst to do that? Looks like it's kicking in. But to me, this is more a normal cycle of deflation that follows inflation. And by deflation, it means something that goes up too high goes down. And the number one major final asset in the planet that's way overinflated by some measures is the U.S. stock market. So a good simple thing I just will be publishing them by the time we put this out on July 1st, this is June 30th, is you look at the earnings yield, the one-year earnings yield on the S&P 500, it is about almost 50 basis points negative to 10-year note yield. That's the lowest since 2002. So it's just an example of how high, how elevated the stock market is, how low the earnings are, and what's your alternative? You get risk-free treasuries at right now 4.25, and that 10-year note, that long bond peaked around 5%. It looks like those are tilting towards deflationary forces, and to me, the key thing that's stopping it is a stalwart U.S. stock market, which means the risk is it's got to stay strong, or we tilt over toward a normal deflationary cycle. Well, first of all, tariffs are a one-off, and the way deflation really works is when you have an asset, let's say the price of a home that goes up to $400,000 from $200,000, which is what we've done in the U.S. average home price maybe the last decade, and it goes back down to $300,000 or so, that's deflation. Just from a previous level. It depends on what period you measure it. So for instance, right after crude oil spiked in 2022 and 2023, we saw some deflation in the 12-month measure of PPI because crude oil dropped. The last time we had that happen was in 2009 because that 12-month measure measured lower. So always remember what inflation is. It's a price level over time, and you measure it on 12-month basis typically, and oftentimes that 12-month basis, that price measure could be lower. And that was the key thing for everything is let's look at deflation in, say, crude oil. The price has deflated well from 130, basically dropped 50% from 130 peak in 2022. At the same price right now, 65, was first traded in 2006. Okay, that's a commodity. Get it? It's elastic to supply. So elastic to supply and demand. Look at the Hang Seng Index. It's probably unchanged over a 20-year basis. That's probably deflationary. And the key thing that's been inflated is U.S. stock market. So it's the measure over time and where you measure it from. Since we've reached 100,000, that was December 6th, the first 3 p.m. close above 100,000. Now, closes matter now for Bitcoin. People say it doesn't close well. With ETFs, they close at 4 p.m. On that day, December 6th, Bitcoin was the first day it closed above 100,000. To me, it was a key threshold. But since then, gold's up about 30%. Bitcoin's up 7%. Stock market's barely unchanged. That's the total return. To me, that's a sign of a threshold similar to 5,000 in the NASDAQ in 2000. Some of us remember that really well. So to me, this is a sign that the massive speculation to this digital asset that helped get the president elected because he tilted over and finally turned in favor. Just point out things where he wrote about 5 years ago. Now is at a level where I look at it reminds me of the nomenclature. You should be selling when they're yelling. And there's so much yelling in this space. Bitcoin looked great at 10,000, but at 100,000, it's just highly risky and speculative. And this is what it's showing. Gold seems to be picking up on that.
In the interview, MikeMcGlone argues that rising stock and crypto prices are ironically pressuring the Fed to stay hawkish. He sees current market optimism as irrational, fueled by buy-the-dip momentum, despite weakening economic data. With inflation still sticky and global yields pointing toward deflation, he believes gold's 25% surge signals deeper economic stress ahead. Markets currently anticipate 2 rate cuts totaling 50 basis points this year, starting in September. Investors are now eyeing Friday's personal consumption expenditures data for more clues on the Federal Reserve's policy path. Non-yielding gold thrives during times of uncertainty and inflation, but higher interest rates make it less attractive. Gold has posted strong gains during the more muted inflationary environment from September 2007 through July 2008, when consumer prices rose by more than 5% due to broad-based price increases in oil and food prices, as well as rising demand from emerging markets. Bloomberg's MikeMcGlone sees echoes of 1971, warning that today's overheated markets and record valuations may signal the end of Fed-driven wealth creation, with gold flashing early signs. Let's get back to the interview.
I think the stock market is anticipating the bill from this great big bill to make a big difference with earnings and markets, and anticipating Federal Reserve easing. But it could be potentially a bit irrational and delusional at this point, because by the stock market going up, making record highs, and things like Bitcoin going up, making record highs, it's increasing that inflation pressure on on the Fed, and it's just silly to think that the Fed would be easing in this environment, because typically that's where they hike rates. It's just not usually how it works. But markets front running. I think it's in its stage now that it's never going to go down until it starts going down, because there's so much buy to dip momentum going on. But everything, as you pointed out, I mentioned earlier, is actually starting to tilt lower. For instance, we expect our Estelle, who is our economist, who's filling Anna Wong for Anna Wong this morning. Our morning meeting expects it. Then the employment rate to pick up to 4.3% on Thursday. Expects non-farm payrolls to be a bit weak. She sees gains in leisure and hospitality slowing down. Gina Martin Adams, our equity strategist, sees that the the market actually is depending on Fed easing. This complete concentrated returns, the S&P 500. The top 52 stocks are accounting for over like 99% or so total returns. And there's alternatives outside the U.S. For instance, growth in techs outside of the U.S. is much better. So I look at it as this is end of the summertime, end of the first half rally, and the risks are that we go back lower. I look at more of we're entering some of a lose-lose now. Stock market going up means inflation stays sticky. The wealth effect is extreme in terms of GDP. It's the highest in 100 years. And there's no reason for the Fed to ease in environment, yet tariffs are going to start hitting earnings, and that sort of factor. So right now it's great, it's wonderful, but part of where you see that is in gold. Gold's up 25% in the year. It's doing quite well, and I think that's a key indication that the rock beating stocks is potentially going to accelerate into year end. For our economists, the Fed, these numbers are expected to increase into year end. Now we've had some good numbers lately, but that's not a good sign for cutting rates. And to me, the key thing, the number one pressure factor to make these levels, which are still up, remember we kicked in that money supply from 2020, still inching higher, just not at the higher rate, is the number one factor for them to revert lower is the U.S. stock market going down a little bit. So it has to stay elevated. And that, to me, is kind of the key thing that's happening in the markets overall. This is wonderful. It's a great environment, but I'm worried about the key thing, like I wrote for my outlook for gold for this year's the range between 3,000 and 3,500. I brought it back to gold because to me, it's a good leading economic indicator, meaning if we're above 3,500 by the end of the year, which is kind of my base case, that's not a good sign for what you pointed out for stock market and everything. And it's more deflationary because I think that's the greater risk, things you see in China with that yield at 1.65%. If we can get gold back down towards 3,000, that would probably be a good sign the stock market's doing fine. Rates are higher and everything's doing fine in this country. And to me, that's part of where we are. And it's still elevated. Gold's still elevated. And key thing that's happening so far since the last time we spoke is we've had that big spike in crude oil. It's starting to roll over. That rollover you see there is very similar to what happened in 1971 when President Nixon ended the U.S. gold standard. And it looks like it's rolling over. Now it's bounced. But right there, a little bit right there. See how it rolled over? That's what I think we're doing now. But it's not going to be easy. There'll be bounces. So to me, that's what's happening. It's just going to go back towards who knows whatever the mean is. We'll start with 10 on this chart.
Sure.
There you go. There you go. So that's one of the key things I've been looking for. It's just been taking a little while to do it. It can't be easy. Remember, what do we have, like a 100-year chart here? So the day trade doesn't matter. Now, U.S. stock market cap to GDP is 2.1 times. It's the highest since 1929 or so. The U.S. stock market cap to the rest of the world's GDP, the rest of the world's stock market caps. It just recently was a few months ago at the end of last year, the highest in our database going back 56 years. That's what's changed. Right now, the market's much more financialized. But the bottom line is it different this time? And to me, this is what gold's sniffing out, is that the U.S. stock market's extremely elevated. And we probably, what's one thing that's different is we might have reached the end game of Federal Reserve easing. And this chart, what you can see, you can't see, but what's really happened is we have the recent example of way too much liquidity, pumping too much money in the system, and the excess inflation that came out of that from COVID. Now, somewhat of that is not just from pumping too much liquidity, but that's basically what happened. So now we have the lesson of, okay, when the stock market starts rolling over, can we just throw money at it like we did last time to keep it elevated? And the risks are we've reached the end game. And to me, that's what gold's telling us. Things like very elevated in say almost 18 million cryptocurrencies, excess of supply, a lot of hubris in that space. They're telling me that we've probably reached the end game of massive wealth creation in the U.S. And to me, that's part of what gold's picking out.
Gold price could soon hit $4,500 per ounce as global uncertainties continue to push investors towards safe haven assets, experts said on Saturday. The sharp rise in gold prices is being driven by fears of a slowdown in the U.S. economy, fueled by President Donald Trump's renewed tariff policies. If gold is quietly signaling a turning point, are investors ready for a world where speculation no longer outperforms safety? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.